Welcome friends. In this video I am going to discuss about investment banking related details. So investment banking, what is required for investment banking, IB related information. So in I think it was in 20 pages PDF. I will discuss on maximum 20 if possible, or I will continue with the session in next video. So in first, what will be there in investment banking? What is this investment banking? Investment banking means, what is the meaning? Firstly, it will do raising the capital corporations, for corporations, government and institutions through financial instruments. So it will help in raising the, I think, sorry yaar, it will in help in raising the capital, first option. And after that, it will advise the client and on strategic financial decisions. For example, if we see Goldman Sachs, it is a investment banking company, and investment banking, it is advising Microsoft on its acquisition of Activision Blizzard. It will help them navigate the complex financial, legal and regulatory aspects of the deal. So it will help in raising the capital, it will advise the client, and it will help in complex regulatory relating issues, and what are the forms required to be submitted to the regulatory. It will take care of all the things from starting to ending. It is investment banking. Here in Goldman Sachs is the investment banker, which helps to Microsoft, advising the Microsoft on the acquisition of Activision Blizzard company, and he will take care of all complex financial transactions and legal procedures and regulatory aspects in the field. Why it will be need when capital is rising? Here capital may be equity and capital may be debt. So we have two options. In equity capital, what will happen? In equity capital, companies sell shares of ownership to raise the capital. So it in company, its ownership will be sell to the persons, and it will get the capital. Like for example, if we see Google in 2004 IPO that raised $1.67 billion in 2004. That is Google company. That is equity share capital. Where has debt capital? Here debt capital means company borrow money from investors through bonds. For example, if we see Apple company in 2023, it was issued bonds issued raised $20 billion in 2023. It is related to here debt capital and equity capital. In some cases, we will go for the mergers and acquisitions. So it will help in these cases. It will advise equity capital, it will advise debt capital, and it will also help in the case of mergers and acquisition. Mergers acquisition means advising the clients and acquisitions, mergers and corporate restructuring. Like here JP Morgan Chase advising the Dow's Chemical DuPont merger. So when company is merging, the DuPont company is there na, that fertilizers company, that the fertilizers chemical company is merging with Dow Chemical. Here the job JP Morgan Chase's investment banker was helped in advising that mergers and acquisition, and he will take the underwriting position also when there is required that companies, when the company is come for the IPO, and it must subscribe at least 95%, 90% will be there as per regulatory. If the company is not subscribe to that amount, the company need to repay that amount, whatever the amount he has get from that cases. So the company, when it is not want to send that money back, here the company will go for the underwriting. Here underwriters will guaranteeing the sale of new securities for issuers. Like here JP Morgan Stanley underwriting Facebook in 2002, when the IPO came, that a Facebook company, and after that Facebook company required subscriptions is not there, then this Morgan Stanley company was taking underwriting. Means here that JP Morgan company, JP Morgan's investment banker will purchase the shares, how much it will require for the as per regulatory norms, and here that person will get the commission and underwriting commissions and trading and sales, executing the trade in various financial instruments for clients like Goldman Sachs fixed income trading desk, trading bonds for institutional investors will be there. So it will also help in trading and sales where executing the trades. So if you have any financial instruments, it will sell on behalf of you and it will charge commission. If we see that Goldman Sachs will trading some fixed income securities on behalf of company, and that bonds to the institutional investors who is the mutual funds persons, PE funds, hedge funds, that institutional funds will buy from the Goldman Sachs fixed income securities. And what are the roles and responsibilities of investment banker? Here investment banking division oversee all investment banks activities within a financial institution. So here equity capital market is focusing on IPO or secondary offering on private placements of equity security. If you go for the debt capital market, it will handle bonds issuing and other debt financing for clients. If you go for the mergers and acquisition, it will advise the clients mergers and acquisition transactions and valuation and due diligence. Due diligence means it will conducting an investigation before entering into that company's sale or purchase. And when you want to purchase one company, and you must know that company's feature, and you must know the company's brief, you must know the company's history. It will be taking care of by it is conducting due diligence. And trading and sales where executing the trades in various financial instruments, provide market insight and generate revenue for the bank. Where has operations, and due diligence means analyzing the company's financial health and business operations before transaction. So if before entering with that company to purchase that company, it will take care of financial health, what are the hidden liabilities will be there, what are the hidden assets will be there in the company. So and what is the brief of the company, what are the cash flows is there, this all will be take care in the due diligence. And documenting and legal review, that is drafting the contracts and prospectus and other legal documents, this all will be take care of this investment banker. And marketing and institutional investors relations, so attracting the investor and presenting investment opportunities. So it will inform the customers, it will create the road shows, it will create the presentations, it will create the PowerPoint presentations, it will take care of the PPTs and complaints and regulated adherence. So whatever the forms required, whatever the all activities required as per regulation, it will take care of all activities by complying the financial regulations. Here the investment banker role will be advising the client, and what will be there. And here we have taken raising the capital. When company is going for rising, it will take care advising the client, it will raise the capital, and it will help in navigating the complex, it will help in legal structures, and it will help in case of mergers and acquisition, it will go for underwriting also, trading and sales execution. These all are roles and responsibilities which will be conducted by the investment banker. And after that, here some companies will be there AMC, and some companies will be there wealth management. AMC means what? AMC means asset management companies. Here asset management companies means it will management investment portfolios for institutions and individuals on a large scale basis related. So it will take care of whatever the portfolios, investment portfolios is there, it will manage that investment portfolios for institutions, whoever the institutions is there who is having portfolio, that portfolio will managed by these AMC companies and individuals on a large scale basis. For example, this Black Rock is the AMC company. And wealth management means here provide personalized financial advice to and investment management tailored to individual clients. Here some individual clients will be there who is in Chennai clients, that is high net worth individuals. So wealth management will take care of this HNIS, and they will provide customized, that is tailor made specificities, what is the risk they can take, how much return they require, how much investment they can go. So they will take care of here. So here in asset management company will have different portfolio, different institution, different individuals in a large basis, whereas wealth management deal only less members who have high net worth persons. That is difference between the asset management company and wealth management company. Here what is mean this equity capital and debt capital. Equity capital means acquiring ownership with a potential dividend. There may be capital appreciation and you may get a capital appreciation or you may get that dividend. And whereas in debt capital you need to pay the fixed interest, and at the time of maturity you need to pay the principal repayment, that is debt portion. It is related to equity capital and debt capital. Whereas preference capital means it is hybrid security which has features of both equity and debt. Here offering priority, it will give the dividend and it also provide potential conversion to common stock, that is preference capital. And whereas commercial papers means these are unsecured or short-term debt instruments which will be issued by this corporation for the purpose of working capital needs, which the company is running for the operations. So working capital needs, they will issue these commercial papers. For example, if we see that Apple was issued some commercial papers with 3 months maturity, that is related to commercial papers. Now how the company deciding funding source means whether we can go for the equity or whether we go for the debt. How they will decide means by considering its cost of capital, what is the our company's cost of capital, what is our financial health, what is the growing plans is there. For example, startup is choosing equity finance to avoid debt, and whereas well established company opt for debt due to lower interest repayments. So startups will choose equity financing because here startups will do not have the money at the time of starting itself, so they need money, they do not have the money, so they will ask for equity. Because when equity persons is there, that are persons will be the owners, so when owners will not ask the money regularly. Whereas well established company will go for the debt because they don't want to share their profits, so they will better to go for the paying less interest amount will be thinking, so low interest rates well established company. So this is the funding sources. Here price will be determined based on investment bank use different methods will be there, and popular method is DCF analysis, that is discount cash flow analysis method. Here to estimate companies future cash flows and set an IPO share price. And here debt securities, where financial instruments representing debt obligations are paying fixed interest and principal at maturity. Debt securities means it was financial instrument. Here there will be debt obligation will be there and fixed interest will be payable every year, and at the time of maturity they will pay the principal amount. If for example if you taken one 10 years corporate bond with 4% coupon rate, then paying a $40 annual interest per 1000 face value will be there, and at the end of maturity the $1000 will be payable at principal amount at the time of maturity, that is debt security. Whereas money market means here wholesale marketplace for trading short term debt instruments. So here the term will be short term debt will be there, debt instruments. Here the maturity will be less than 1 year will be there, and bank trading that treasury bills in the money market. So they may issue for 90 days, they may issue for 3 months bonds also will be there. If you see that commercial paper that Apple company was issued the 3 months commercial papers, na, that one same like us. Whereas government bonds means here debt instruments issued by the governments. Corporate bonds means where the companies was issued, that is the corporate bonds. Whereas money market means here the wholesale market price trading short term debt instruments will be there, that short term means less than 1 year that maturity. And whereas government bonds means here debt instruments was issued by government considering the low risk, because when government issuing there will be risk will be low risk, so when the risk is low return also will be low, so they will issue investment due to sovereign backing, that 30 years government bonds with 3% coupon rate, etc., etc. And mortgage based securities means here the investment was backed by some pool of mortgages, where here offer exposing to the housing market. For example, Fannie Mae and Freddie Mac is issuing this MBS, that is mortgage backed security. So here investment was backed by some pool of mortgages will be there for back end. This is supporting. And face value means here the nominal value of security, where not necessarily reflecting the market price. For example, bond with face value of $1,000, that is face value. And whereas coupon rate means annual interest rate paid on debt security, means whatever the interest is paying, that is annually interest is paying on a debt security. Example, that corporate bonds with 5% coupon rate, or meaning it's pay $50 annual interest per $1,000 face value. So coupon rate means that is like as a interest rate, whatever semi-annually or quarterly or half yearly, whatever rate they will give on the bond, if they will mention some rate, that rate will be the coupon rate, that is annual interest rate paid on the debt security. Where corporate bond was issued with 5% coupon rate, means it meaning it will pay the 5% on that face value every year annual interest. Next, tenure means maturity date of a debt security. For example, maturity, when the bond is issued, then they will also mention that maturity date, that is tenure time. If we given that 5 years bond maturing at 2029, this is 2024 now, so 5 years means 2029 is the maturing date. Next, different types of risks. What are the risks will be there in the market? So we have one market risk, and we have credit risk, we have liquidity risk, and we have operational risk, and whenever we have reinvestment risk also. Here different types will be there, whereas one concept will be required, that interest accrual concept. Here interest accrual, when market price sale price is calculating, interest concept will arise. Here interest accrual means where how some interest on the debt security accumulates over a time. For example, a daily or monthly or annually. For example, if we say an investor was purchased one bond with 5% annual coupon rate, and 12 months is the maturity. So here investors was purchased 5% bond at a coupon rate and 12 months maturity. This means they accrue $5 in interest every month. So accumulating that 5 into 12, it will become 60 rupees by the end of the year. Here, for example, if we take so in fourth month, if you are selling fourth month, so you need to add that selling price plus interest accrued, because in within 2 months they will get the interest, so interest will be added. There the concept will come, then dirty price and clean price concept, where here dirty price means that if the selling price included that interest accrued, it will become dirty price. Where the selling amount does not include interest accrued, it will become clean price. In here the value will be sale price plus interest accrue add will. Here already will be there now, dirty price into whatever the interest price divided by interest plus principal, you will get the total amount. It is same like as GST invoices. So invoice inclusive of in GST. For example, if we take GST, inclusive of GST means how we will calculate. For example, GST rate is 18, means 100 into 18% means 18 divided by 118. It is dirty price because it was included interest accrued. Whereas 100 into 18%. So it where we are adding for 100 we are adding. It means here it will be clean price. And after that we will see that day convention. Here day convention means it is one method used to calculate. Here we are calculating for interest accrual. For interest accrual 4 months means January. If we take the January month, here 31 days will be there, and in February 28 days will be there. For example, if we take other than March, if we take April, here 30 days will be there. If the in the agreement they will be have act to act basis, then act to act basis means what is there, and actual. Here method used to calculate accrued interest for partial interest period, that is actual to actual. That is here whatever the days will be 31 days here now, but for interest calculation we will take 30 divided by 360, but actually what we will need to take 31 divided by 365, sorry yaar, 31 divided by 365 we need to take, but we will take the 30 divided by 360. Here 28 days is there, 28 divided by 365 means here also we will take 30 divided by 360, and here 30 days will be there divided by 365, but here also we will take 30 divided by 365. That is day convention means for the purpose of our convention we will take the act to act basis, that is 30 divided by 360 days. So when the buying a bond, that is shortly before in interest payment date, the accrued interest from the last payment to the purchase date might be calculated by using the actual to actual method, that is taking into account exact number of days. Whereas the next market price means what? Market price means here current price of the security has determined by supply and demand. So how the market price will be determined based on the demand and supply, where the demand is there, where the demand is increasing, market price also increasing, where the demand is decreasing, market price also decreasing. Here market price and demand, there will be the direct relationship will be there, and often differing from the face value. For example, a bond was issued with face value of $1,000, might be trading at 980 rupees. So face value is 1000 and it was trading at 980 rupees in the market, maybe due to change in interest rates. So here interest rates and market price will be how indirect relationship, where the interest rates are increasing, demand will fall. Interest rate is decreasing, market price will be increases. That is the case. So based on increase interest rate or ensure credit worthiness, that will be the reason for market rate decreasing. Where the here impact of share price when the interest rates changes. So when rising interest rate is there, generally stock price will fall. What we have discussed, that indirect relationship, as an investor prefer bonds with high guaranteed returns and vice versa. For example, if Federal Reserve rises some interest rates, so banks are rising interest rates, then technology stocks with high valuation might experience significant price drops as investors seek safer investments. So when the rates are increasing for new bonds, old bonds, whatever the persons will be there invested in old bonds, they will sell that old bond, they won't go for new bonds. So here bond new old bonds price will be decreasing. Next, credit rating. Credit rating means here independent assessment of an issuer's credit worthiness by the rating agencies. Some rating agencies will be there, they will give the ratings for this company, so for the purpose of credit worthiness. For example, if the standard credit rating company or Poore's credit worthy company or Moody's credit worthy company or CRISIL credit worthy company, here wherever the high rating was provided, then low risk will be there. For example, if a government bond is there, for that government bond these companies will give triple rating from S&P is considered. It means triple rating from S&P means it is extremely safe compared to corporate bonds with B rating. So company has here triple rating, and here corporate bonds may have B rating. So next, yield curve. So yield curve will, it means what? Yield curve means it is graphical representation of relationship between interest rates and time of maturity. So YTM. So YTM of debt security and same credit quality. Here YTM and coupon or interest rates. Here best for these two items, they will provide the graph representation for this relationship between the interest rate and time of maturity. So different types of curves will be, one is normal yield curve, that is normal yield curve means upward sloping, here indicate higher yields for longer maturity will be there. So upward sloping means always going in a upward sloping, here indicate means it will going providing higher yields for longer maturity. Here investors will expect higher return for lending money for a longer period, here the investors will go for the longer period because they will getting more interest than market was providing. Whereas example, if you go for the US treasury bonds might offer 1% annual yield for 2 years notes and 2% yield for 10 years bonds. So less time, if it is there less time, it means more less risk, so less risk, so less interest will be there. If it is more time, time is more, so then risk will be there, so then they will increase the interest rates. So here the US bonds for 2 years they will give 1% only, for 10 years bond they will giving 2% yield, which is normal yield curve. Whereas we have inverted yield curve means here down sloping will be there, here signaling means they will providing low yield for longer maturity. So here investors will go for the safety for short term bonds. This often indicate an impending economic recession. So inverted yield curve means there is a recession period. Here recession period means what? That GDP of sorry here, recession means GDP of the country for last two consecutive quarters was decreasing trend. This is a recession time. When recession time, the companies will think to reduce their cost. For reducing the cost, the companies first mind will get from employees. So whoever paying the employees salaries, so they will think on employees, so they will remove some employee jobs. That is going happening in IT sector as of now. So many recessions were there and so many employees were getting out from the companies. And whereas that is inverted yield curve means recession period was happening in that case. And whereas flat yield curve, here relatively flat line suggesting similar yield across March years. So for example, this could represent an uncertain economic outlook where investors aren't confident about future interest rate changes. For example, if we see in corona time, COVID time, that some companies, whatever the company it will be, if the name is relating to pharmaceutical, if the name is related to hospital, if the name is related to healthcare, that all companies share price was went like anything. Even that company is not a hospital company, once some mechanical company is there and some name is relating to hospital, this share price was went like anything. That is, there is no certainty, there is uncertainty will be there, and investor does not have confidence for future rates changing. That is relating to curves. So we have three curves, one is normal yield curve and inverted yield curve and flat yield curve. After that, IPO process, here transforming a private company into public company means, here IPO process means initial public offer, where our private company is going for public entity or our private company going into public, it is known as IPO. Here IPO, pre-IPO stages will be there, where here we in pre-IPO stages we will select underwriters. The company choose investment banks to guide the IPO. So whatever the investment banker will be there, so they will go for that investment banker for the guide to IPO process. So investment banker will guide this total IPO process. They will take care of underwriting. Where here example, if we see Uber, at the time of Uber want to go for IPO, they appointed Morgan Stanley and Goldman Sachs as a lead underwriters for its 2019 IPO. So in 2019, this Uber company was went for IPO and they was provided, just a second here. So in 2019, Uber company went for IPO. They were appointed this Morgan Stanley and Goldman Sachs lead underwriters. Next, financial scrutiny. Here financial scrutiny means that auditors, whoever the auditors will be there, the person who has the membership number from the Institute of Chartered Accountant India, that person is known as auditor, and he will prepare the audited financial statements and prospectus disclosing the company's financials and business plans and risks, etc. So this is financial scrutiny cases. Whereas regulatory hurdles will be there. So regulatory hurdles, approval from the relevant authorities like Security Exchange Commission will be there. So from that there we need to get the approval and obtain that ensure compliances will be there. And what and road shows and marketing, so they will give the seminars on this company and they will promote like anything. They will give road shows and they will give marketing. For example, building buzz, underwriters organized investor meeting and presentation to generate interest. Example, Zoom held a virtual investor meeting during the pandemic to showcase its growth potential. So they will see that like billing with and roadshows. Company execute travel to major financial center to meet with investors. For example, Beyond Meats executive travel to New York, London, Hong Kong for its IPO roadshows. So for order booking, so second one is first one is it was pre-IPO stage. The company was meet the investment banker taking care of marketing roadshows, and after that they will order booking paid. So here order book billing, the price will be discovered. Here investors submit some bids for shares at a various price point and creating order book, and here final price will be underwriter analyze the based on what is the demand will be there, and based on that demand he will set one IPO price. Here for example, Snowflakes was came for IPO, price was set up at $120 per share. The valuing of the company at over $33 billion. Next, after that, price allocation. For this price setting IPO pricing, they will choose two methods. One is fixed method and another one is book billing method. Book billing method means here they will quote price range, maybe 120 to 150. This is the price range. If they quote fixed amount, that is fixed rate. Book billing means they will quote in a price range. After that, pricing and allocation. Here shares distribution. Shares are allocated to investors based on their bids and total funds raised. Based on their bids means this whatever the bid prices is there, and based on their whatever the fund they are raising. For example, if you see Robinhood was allocated shares to its IPO to both institutional and retail investors. So they are allocated to its IPO for institutional and retail institutional investors and retail investors. Trading debut. Here the company share beginning trading on stock exchange, marketing its public launches. And for example, if you see Coinbase shares begin trading on Nasdaq on 14 April 2021. Next, after that, what is this IPO life cycle? If you see IPO life cycle means obviously same only, that is pre-IPO will be there. Here preparing the legal groundwork and regulatory approvals. After that we will go for the offering marketing and roadshows, order booking will be there, and after that we will see that pricing and allocation. Here determining the final price and distributing the shares. After that post IPO, here managing the public trading, providing post offering support. Post offering support means what? If the company is went for over subscription, after that if they are not allotted shares to more persons, the persons will disappoint, they get negative and the stock price will get into negative. So the stock price may chances to go for down. So at the time of that case, the companies will go for the green shoe option. So here green shoe option, they will give additional right that IB company will purchase another 15% from the retail investors and they will give back to promoters. Navigating the public spotlight. Here who will be there in key participants at the time of primary market. In this first person will be issuing company. The company raising capital through IPO is the person issuing company. The company who is raising the capital through IPO is known as issuing company. Next, after that, underwriters. Here investment banks guide the IPO process. So whoever the investment banker is there, they will guide the IPO process. Issuing company means raising capital through IPO, and underwriters means who will guide the IPO process. And after that, investors will be there. Investors mean that individuals and investors who are purchasing the shares in the IPO. These are the main persons for primary market, and these are additionals. Regulatory means who are overseeing the IPO process and ensuring investors protection. And after that, legal counsel, that is advising the company and underwriters on legal aspects. And where has public relations firms shaping the company public image and managing media relations. So these are all persons will come in this case only. If we take this investment bank, this legal counsel, public relationship, whatever the required regulatory, they will take care of that in view only. So for primary market we have three persons: one is issuing company, one is investment banker, one is investors. So these three persons is the main for the primary market, where if the company don't want go for the IPO but it want listing in the stock exchange, is it possible? Yes, it is possible by going with through the direct listing. Here going public without underwriting, they do not require for underwriters, because when underwriters will come into picture when the company is issuing into the public, and if the public is not subscribe the shares as required for the regulations, then these underwriters will be required. So then at that point of time underwriters will buy the shares and they will get the commission, and they will fulfill that regulatory policies. So that here direct listing where underwriter is not required. For example, some companies were taken that direct listing, like if we see this songs playing company Spotify and Slack opt for direct listing instead of the traditional IPO route. So this means bypassing underwriters and directly listing their shares on the stock exchange with their direct listing. What are the benefits will be there for direct listing? So this whatever the Spotify company, that is songs company, song plays company will be there na? That songs plays company went for a direct listing. Here whatever the benefit will be there and whatever the drawbacks will be there. Firstly, benefits means it is cost effective, so they need not to pay any underwriter fee, they did not incur any underwriter fee, first one. And after that, transparency, existing shareholders can directly sell their shares. So whoever the shareholders will be there, they can sell their shares. And speed, faster than traditional IPO. So in IPO we need more time will be required, because the drafting, red herring, prospectus issuing, and awareness creating and conducting programs and different times, and we will mention in different apps, different sites for publishing the shares, and the advertisement will be required for where IPO. Here in direct listing it does not require that much of time, and it will be faster than the traditional IPO. And where has drawbacks will be less marketing support, where underwriters typically help build investors interest. So and the middle person is there, he will talk like anything, he will talk like anything, and he will ensure, he will give the information to these companies, and they will ensure that more persons will come and they will give more persons more amounts. Next, price volatility, shares may experience greater price fluctuation initially. Next, they will corporate actions, if the event changes shareholders right and ownership. Next, corporations occur throughout a company's life cycle and can impact the share price. If you go for the stock split, for example, if you go for the stock split, here the stock split number of shares will be increased. So stock split means increasing the number of shares will be stock split, that potentially shares will be increased. If we see latestly that Tesla company went for this stock split, so 5 for 1 stock splits in 2020 made each share more affordable, potentially attracting more investors. What are the impact will be there in that cases? So neutral on total value per share, but may increase liquidity and short-term volatility. Because of this short-term stock split, value per share will be neutral, and it will be changed in value per share, and liquidity may increase and short-term volatility may change. And where has stock dividend means this dividend means distributing the portion of company's profits as additional shares. For example, if we see that Apple company was paying periodically issuing stock dividends, rewarding loyal investors with ownership growth. So here they will giving their ownership, the company's ownership growth to their investors who have royal investors by rewarding in case. Here impacting will company earnings will be decreased and slightly dilute their existing shares, but create potentially long term values, because when we are taking our investors into ownership, they will work like anything, and Here next after that cash dividend. So we have stock dividend and cash dividend. Cash dividend means distributing portion of profit as cash payment to its shareholders. For example, this Microsoft company is there. Microsoft company will regularly pay this cash dividends, that is providing investors with income. So here impact will be companies cash reserves slightly decreasing, slightly depress the share price in the short term but offers immediate returns. Next, shares buyback. Buyback means our company will buy the our shares in the market. Company repurchasing their own shares from the market. Here reducing the number of outstandings will be there, it will reducing. For example, if you see that Alphabet, that is Google parent company will be there, has engaged in significant shares buyback, boosting EPS and potentially driving up the share price. Next, impact. What is the impact? Here increase the ownership concentration will be increased and EPS will be increased and potentially driving up the shares price and reduce outstanding number of shares and can be seen sign of confidence in the company's future. Next, understanding the different events and their potential impact of share price is crucial for the informed investment decision. If we see different corporate actions will be there, what is the meaning and what is the share price, we will go for the one live example of these cases. So firstly we will go for the mergers and acquisition. So mergers and acquisition means merging means combining two companies, acquisition means purchasing by one company for another company, and where has meaning means here two companies combined with one acquiring the other. Firstly, merger means two companies will combine, it will be merger, and acquisition means acquiring one another. That is the case. Here impact of the share price will be acquired company's price may rises. So company share prices may rises in this case due to premium, and acquiring company might dip initially but potentially rise long term with strong synergies. So here the acquired company price may increase and it will also get the synergy benefits. So whatever the synergy benefits will be there, that synergy benefits also you will getting. For example, if you see that Microsoft was acquisition Blizzard, activation or Blizzard price rises or Microsoft might fluctuate. Next, spin-off. Spin-off means a company create new or independent company from its existing operations. For example, if we see Nokia company, so Nokia company is a mobile company, it also create one independent company, that is batteries. So Nokia batteries will be there. So where parent company price may not change significantly, while spin-off price depends on its feature. So for mobiles it has not changed any price, but the battery price was quality will be there, so price also increased for this battery also. It was dependent based on the dependence on its feature. Next, for example, if we see live example, that PayPal spinning of paddy, that is PayPal price might be stable, paddy's price may based on its own valuation. So potential and market sentiments will be there, whatever the based on that it will prices may be changes. Next, rights offering means existing shareholders can buy additional shares at discounted price. So here the whoever the person's existing shareholders, they will get their additional shares at a discounted price. For example, in market the price was going in 100 rupees, but the company will issue these shares to their existing shareholders at a 50 rupees. So here the share price may temporarily decline due to dilution but stabilize after the offering. So at the starting it may dilute, it may temporary, it will decline, but in offering period it will stabilize the price. Here, for example, company offering rights to purchase new shares at a discount, where potentially diluting their existing shares. Next, stock options expiry. The stock option expiry means here that employees will be there. Na company employees ESOP schemes. Employee stock option expires or allowing holders to sell shares if they wish. It is like a buyback. Can this cause short term downward pressure on share price if many options expire at once. So if the all persons expiring will be there in same time, then the pressure was high and the share price may go down. Here large number of employee stock options expiring in a company. Next, delisting also one corporate actions. Here delisting means a company is removed from a stock exchange, where we have seen IPO, that is initial public offer. After that we have go for went for direct listing. After direct listing, if you want come out from the listing, we can delist the company. For delisting we have three options. It may for as per regulatory, as per voluntary, or as per some plan wising, that another corporate action may be. As per regulatory means we need to submit that financial statement, annual returns, quarterly returns. We have not submitted that, regulation what told that you need to delist from the stock exchange. And voluntary we need to go for the delisting, because we are incurring more expenditure because of this listing, so we need to went from the delisting. We need some public image, some news about our company, we will go for the delisting, where has share price typically plumped at trading liquidity and investors confidence may diminish. Here company being delisted due to non-compliance or financial difficulty will be there. And shares conversions, here converted bonds or preferred shares become common stock. Change here the whatever the capital will be there, that capital structure may changed, may dilute existing common shares and potential depress the price unless the conversion adds value. So whatever the existing common shares will be there, it will dilute and potentially it will depress the price unless conversion was added to the value. Next, convertible bonds in a company converting to common stock, increasing the number of outstanding shares. Next, change of control. Here change of control, a major shareholder gains a controlling stake in the company, here potentially leading to new management and direction. So share price here may be volatile depending on the market expectations for the new leadership and directions. So here major shareholders acquire a controlling stake in the company, potentially changing future prospectus. So changing control also one corporate action. And here all corporate actions, one is change of control, it is corporate action. Shares conversion, it is corporate action. Delisting, it is corporate action. Stock option expiry, it is corporate action. Rights offering, corporate action. Spin off, corporate action. Mergers and acquisition, it is also one corporate action. And where has this shares buyback, it is also corporate action. Dividends, that is dividends may be stock dividend and cash dividend, it is also one corporate action. And stock split, it is also one corporate action. So these all are corporate actions. What is corporate action meaning? What is the corporate action means? It is one action or it is one event taken by the company, it will impact the shareholders wealth. And after that corporate action we will go for the secondary market. In secondary market what will be there? In primary market we have three persons. Who are the three persons will be there? One is in who is company, investors will be there, and another one will be investment banker will be there, and company will be there, what incorporating company. And secondary market, in secondary market he is where previously issued securities, that is stocks or bond etc., are traded between the investors, not directly from companies that issued. So here the security market means already previously some issued securities will be there. The securities may be stocks, bond etc., so or it will be traded between investors, not directly from the company that is issued. So here the company is not issuing, but it was traded through these investors. Here investment bankers contacts, if we go for investment bankers, facilitate trading for clients or collect commission, management portfolio, advice strategies in this market. So here the whatever the investment banker will do, they will trade the on behalf of client, and they will collect some commissions, and they will manage the portfolios, and they will advise the strategies in this market. Here whatever the purpose will be there, so here the purpose will be provide liquidity for investors. Just a second guys, I think okay, it will be there now. Okay, come to the point. And investment banking provide liquidity for investors to buy or sell securities quickly. Here it will determine fair value through price recovery mechanisms, enable the corporate governance through shareholders voting. In secondary market, generally these investment bankers generate revenue through commissions and fees, manage the client's portfolio, advise on the investment strategy. Here the participants will be individual investors will be there, that is buy and sell securities for personal goals. And second one, institutional investor, that is large organizations like mutual funds, pension funds or hedge funds, anyway different institutional investors. And after that, market makers, that is providing liquidity by quoting bid price and ask price. Bid price means buying price, ask price means selling price, that is offer price. And regulators, where that is security exchange commission, that will ensure the fair and transparent trading. Whereas investment bankers, here the investment bankers will facilitate trading, manage the portfolio and advise the clients. There may be hedge funds also. Hedge funds means leverage bank resources for complex trading strategies. Leverage means here they in leverage we have option that we will borrow the shares and we will sell the shares. After that we will buy the shares and we will give back to that shares whichever the buyer. So here the we assume that in future the share price will be going down. So in future it was going down because now the high price is there. Because now is the high price, we will sell at now in the smart market, in the spot market, and we will buy at the later when price is decreased. So we do not have the shares as of now, because we do not have, we will borrow that shares from that persons and we will sell. And after that 3 months or 2 months, whenever the price was decreased, we will buy that shares and we will repay that to from whom the we are borrowed, and we need to pay some interest also in that cases. That is leverage. And portfolio managers who will make the investment decision for their clients. Here some bid means what? Bid means highest price for buyer is willing to pay. So whatever the amount is need to willing to pay, that is high buying price, is known as bid price. For example, if you see Goldman Sachs received a bid of 150 per share from hedge fund clients for 1 lakh shares of Apple stocks. So Goldman Sachs was the investment banker for this Apple stock, and he was received bid price at the rate of $150 per share for their hedge fund clients for 1 lakh shares of Apple stock. And where has ask means here the offer price or sale price. Here low price of a seller is willing to accept. Here JP Morgan finds a seller willing to accept $151 per share for Apple stock, facilitating the trade and ensuring the spread. Here Goldman Sachs is buying side, and where has JP Morgan is selling side. So here the both main top 10 companies were there as a investment banker for this Apple company. Company is went for this cases. And IPO, a last traded price means, here the last traded price means the price at which the most recent trade was occurred, that is last traded price. For example, the last traded price for the Tesla stock company there which is coming for this Gujarat, for the constructing that new company which is establishing in Gujarat. In recent time also he told that he is coming into Gujarat. Now we will see that market price there, whatever the market price will be there. For example, $750 is there, that is last traded price will indicate its current market price. And we will see in the market we have opening price and closing price. Opening price means that is first price recorded at the start of the trading. So when the market is opened, market was opened at the time of 9:15 to 3:30 time. So in between this time, when the first trade was happened, that first trade price will be taken as open traded price. And where has closing price means, if we see at 3:30 time is the date will be there, 3:30. So the final price recorded at the end of the trading day will be the closing date. But if we will not take the last trade here we will take last trade means last 30 minutes average price will be taken as closing price, the closing price. So for yesterday's closing price, for today opening price, but we have some differences because we will take the average price. Next, circuit breakers. Yes, circuit breakers means sometimes the stock exchange will temporary trading halts will triggered by some rapid price swings to come market. So some news was came, and for that news the rumors was came. So for that rumors the investors who are buying morely and selling morely, then this circuit breakers was used by this stock exchange. In if you see in March 2020 where circuit brokers were activated multiple times during the stock market crashes or passing the trade to prevent the panic selling. So some panic news was there in the market, then at that time stock market will stop the trading of that particular company share, because in this panic without knowing the correct news, but by considering that rumor news, the stock prices, the volatility of the market or this stock market will crashing. So when the stock market is crashing, it will stop in between the 9:15 to 3:30 time. The activities were breaks, that is known as circuit breaker, here activated multiple time in case of March 2020. There when it is, I think it is COVID period time, and where has we have two limits, one is upper limit and lower limit. Here the upper limit lower limit means here predetermined maximum and minimum price for the security daily movement. If we see for example 100 rupees is the previous price, for if we are buying some shares you are taken 100 rupees, by mistakenly you are adding 200, it will not taking for that amount, because in we have limits. I mean if you go upper limit or if you go for the limit, I think 25% or 20% they will kept upper limit lower limit. So up to 125 it will consider, or lower means up to 75 it will consider, below that or above that it will not be considered, because there will be limit for the maximum and minimum price for securities on a daily movement. So it means the movement of price up to 20 to 20% will be there for limited. Some exchanges have upper and lower limit of 10% for daily price fluctuation to curb the volatility. Next we have market order. Here market order means an order to buy or sell at best available price. If you know that price is best available, for example company starter technology company shares is there, if you think that 1300 is the best available price, so you are quoting that 1300, it will see, and if the price mentioned whatever the your price is went for the NSE, it will display, and you are buying side and another person who is selling he also quoted that 1300, then transaction will be executed, that is best available price, that is market order. For client instruction was this Morgan Stanley to execute a market order to buy 500 shares of Alphabet, prioritizing speed over prices. Next after that limit orders. Limit orders means an order to buy or sell at specific price or better. So limit order means here the order to buy or sell at a specific price or better prices. So here we will quote a price will be in 1500 to 1550. So we will limit the order. A portfolio manager at Bank of America FIFC place a limit order to sell 1000 shares of Meta at 180 or higher. If the price is went for 180 or higher, then only the transaction will be executed. It will ensure the minimum price. Partial order means an order to buy or sell only portion of desired amount. So they will not focus on whatever the funds. So here they will focus on a client with limited funds request partial order for 200 shares of Netflix, even though they ideally want to 500 shares. So they want 500 shares, but the company does not have, the client does not have the fund, so they is going for 200 shares of Netflix company. And in the secondary market what is the investment banker role in secondary market? They will do trading desk. Trading desk means executing the client order, managing the risk and capitalize the market opportunities. Next, investment research. Here analyze the market, companies, securities to inform clients decisions. Next, portfolio management. Here build and manage client portfolios based on their risk tolerance and goals. Next, sales and trading. Build the relationship with clients, understand their needs, recommendations and investment strategies. Investment bankers will advising the companies on that mergers and acquisition, IPO process and other capital raising activities. For example, if you see the investment bankers in actions, that Goldman Sachs will advising such SoftBank on the sale of Arms Limited to Nvidia. This is their complex deal involved in navigating the different market conditions. They are managing regulatory hurdles, negotiating the best possible price for SoftBank. So they will think on SoftBank side. And whereas JP Morgan Chases arranging a secondary offering for private equity firms seeking to exit its investment in the biotechnology company. So where this private equity funds were seeking to exit from this investment in biotechnology company, this JP Morgan Chases will allow, and this required finding institutional investors willing to buy the shares at a price acceptable to the private equity firms. In private equity, this private equity firms means private equity hedge funds will register as a closed-ended funds. They will go for the 5 years or 10 years. After the 10 years they will go for the IPO, or after they will sell to another firms. Here the company private equity firms was existing period liquidation time, they are searching for come out from that biotechnology. Here the JP Morgan Chases will arrange that second offering. Whereas another example, Bank of America providing line of credit to hedge funds for short-term trading strategies. Hedge funds means we will go for the short-term. Private equity funds means they will go for the long-term, and hedge funds for short-term trading strategies. So here credit was providing this Bank of America. This involved assessing the hedge funds risk profile and collateral requirement and potential returns. So they will see the risk, what is the risk will be there, what is the collateral requirement, what is the potential returns will be there, and after that challenges and opportunities. What are the challenges will be there and what are the opportunities? Challenges means market volatility. Here investment banks need to adapt to rapidly changing market conditions and protect clients portfolio from potential losses. So market volatility means where the investment banks need to adapt some rapidly changing market conditions. So there will be different conditions will be there in market. The market conditions will be changing rapidly, so investment banker need to adapt to that changing market conditions and protect clients portfolio from the potential losses. Technology advancements, whereas high frequency trading and algorithm execution require banks to invest in sophisticated technology and data analysis, because they are working in a high frequency case. So they need more technology, they need more algorithm execution, they need sophisticated technology, they need more data analysis something. And regulatory landscape, here they will evaluating that regulations and compliance requirements which add complexity to investment banking activities. Next, attracting and retaining talents. Here top tier investment banks compete for highly skilled professionals with expertise in trading, research and portfolio management. After that we need to know about the trading life cycle. What is there in this trade life cycle? In trade life cycle maps here the journey of trade from order initiation to settlement, that is known as trade life cycle. So from in starting of order and we need to settle the payment, so this is known as trade life cycle. Here breaking down the key stages, first will be order generation. Here investment banker clients contact their investment banker representatives or use an electronic trading platform to place the order, that is buy or sell specific securities at their desired price or desired quantity. So here first stage in the trade life cycle, placing the order. Next, after that, order type. Here we will see the market, that is immediate execution at a best possible price, or we will go for the limit, that is executing only at or above below specified price. We will give the best price or 500 rupees, or we will go for the 400 to 500 is our price, that bet or below average price, or we will go for the partial buy sell or buy or sell only portion of desired amount. Next, order routing and matching. So firstly, order generation. In order generation, we have the investment banker will help for placing the order, and order type may go for the price, that is market, based on market best available price, or limit price, or partial price. And second point, it may be second stage will be order routing and matching, trading the desk. So here orders are routed to relevant exchanges, that is maybe NSE or BSE, or internal matching systems depending on the security and execution strategy. Here matching engine will orders are matched with the counterparties offering complementary terms, the buyers and sellers with matching price and quantity. Next, confirming and clearing. Here confirming and clearing means trade confirmation, that is both parties receive confirmation of the executed trade, or it includes details like price, quantity, settlement date, etc., etc. That is confirmation and clearing. And after that, clearing means clearing house guarantee trade execution and manage risk by ensuring the delivery of security and payment of settlement data. So we have first stage will be the investment bank, this order, placing the order, and after that order type. Next, order routing and matching. So we will match the who is the person is matching for us. So we are quoted this one, and another person who has quoted same type, they will matching that order routing. And after that, confirmation and clearing. Once trade is confirmed, both the parties receive confirmation of the executing trade, including details like price, quantity, and settlement date. And after that, clearing will be happen. Here clearing house will guarantee trade execution and manage risks by ensuring delivery of security and payment on the settlement date. And the settlement means what? Settlement means delivery versus payment, means securities are delivered for the seller to the buyer, and why buyer will payment is transferred to seller. This is ensuring simultaneous exchanges should be happen. Settlement system means centralized system facilitate efficient and secure settlement of trades, that is amount will be payable, whatever the amount payable they will pay, and whatever the items we need to deliver, we will deliver the item. This is a trade life cycle will be happen in the market. After that, we will see that AML regulations. AML regulations means anti money laundering regulations. Here anti money laundering regulations means combating financial crime, that is money laundering, is the top priority for investment banks. So they must comply with stringent anti money laundering regulations. So anti money laundering means we have act also, that is prevention of money laundering act. If you see in today's news also that Aam Aadmi Party was accused this prevention of money laundering act, that is the AML related information. Here they will prevent criminals from using financial institution to launder the illiquid funds, that is dirty money. Where protect the integrity of financial system. So they will try to protect the integrity of the financial system. They will mitigate the reputational and legal risk. Here what are the key elements will be there in EKAML components. First we need to know about the KYC. KYC means that know your customer. Know your customer means identifying and verifying customers' identities through documentation and due diligence, that is KYC norms. So must in any cases, if you go for the bank, they will taking this KYC norms only. KYC norms means identifying your customer and verifying your customer's identity through documents, Aadhaar card, PAN card they will take, and diligence. After that, CDD will be there. CDD means assessing the customer risk profile. CDD means customer due diligence. Here assessing the customer risk profile based on the business activity. What is the business activity he is conducting, what are the source of fund will be there for that person, and potential for the suspicious activity, that is what is the suspicious activity he is potential for that person. This is customer due diligence. So you will assessing customers risk profile based on the business activities. You will see the source of funds, what are the source of funds will be there, and he will see the potential for suspicious activity. Next, EDD, that is enhanced due diligence. Enhanced due diligence means applying stricter verification and monitoring measures for high risk customer or transactions. So EDD means applying the strict verifications will be there, and monitoring measures will be high risk customers with the person having more risk. This like political persons is there, the persons will have more risk. So when the person will require to open any account, they will direct to go for the director. So authorization will be required from director, then only these political parties will get the account in that bank. That is enhanced due diligence. There will strict verification will be there, monitoring measures will be high risk customers or transactions. Next, suspicious activity report. So SAR report will be providing, that report will have suspected money laundering or terrorist financing activity to authorities. So when the money was depositing or when money is transferring from another person, there will be suspected from that money, or there will be financial activity to authorities. Next, compliance programs. Here implementing policies and procedures to prevent and detect, that is AML, anti money laundering, or CFT, that is countering the financing of terrorism, that risk, CFT risk. For example, an investment banker will identify a new clients wanting to invest large sums in securities. So during the KYC, discrepancies are found in the client's documents. So here in KYC that discrepancies was found in client's documentation. Then EDD will conduct, means verification, strict verification will be conducted, and revealing the potential links to shell companies. Shell companies means these dummy companies will be there some cases. Based on this, the banks will file SAR, that is this suspicious activity report, and may even refuse the client business to mitigate the AML risks. In categories, we have different category of customers. One will be retail customers, that is individual investors with lower risk profile. We have lower risk, this is retail persons. Next, wholesale, that is institutional investors like this hedge funds, pension fund, PE funds, mutual funds, which have some higher risk profile due to complex activity and large transaction. They will doing in more complex activities, they are in more large transactions. Next, correspondent banks. Here banks will acting on behalf of other banks. So here bank will acting on behalf of other banks, requiring EDD due to potential exposure to foreign risks, and whereas AML tools and techniques. So transactions monitoring system, analyzing the transaction for suspicious patterns indicating of money laundering. So when this AML, what is the tools will be there or techniques will be there. First they will monitoring systems, by they will analyze the transaction. If the transaction is suspicious pattern, they will indicate the money laundering. And after that we have sanction list, screen list clients and transactions against list of individuals and entities subject to sanctions. So they will go for the, so if you have persons have any risk, they will clearly tell that person go for sanction for subject to some sanctioning terms and conditions. Some risk based approaches, that is tailoring that AML, anti money laundering, CFT measures to specific risk profile of the customer and transactions. Yes, CDD means that customer due diligence, the basic level of customer identification and verification required for all financial institutions under AML regulations. So what is the purpose for the CDD? Here purpose will be to obtain enough information about customers to understand their identity, to their source of funds and business activities, and thereby assess their potential money laundering risks. And here they have stages will be typically includes verifying the identity documentation, address, contact information, and as well as understanding the nature of customer business and its investment goals. Next, here example will be the investment banker will conduct CDDs to a new client by verifying their passports, proof of address, bank statements, along with inquiring about their employment and investment goals. Whereas EDD means enhanced due diligence. Here, more rigorous level of customer verification applied to high risk clients or high risk transaction. Here purpose will be to gather the deeper information, means we need to get the more information and conduct more analysis to mitigate the potential money laundering risk associated with the specific customers or activities. Here stages will be in addition to CDD steps. So in addition to that CDD steps, here EDD might involve investing the source of funds in detail, obtaining references, examining financial transactions, assessing the customer relationship with potential exposed person, that is PEPs person. So potentially exposed persons, politically exposed persons will be there, that PEPs person. So we have politically exposed person will have more risk. So for that person we will conduct EDD. For example, an investment banker identifies the client seeking large anonymous transactions in the complex financial instruments. So if we go for this, political person is there. Political person will known as PEPs, that is politically exposed persons. For that person or that person's relative, for that person's wife, that for that person's sons, relatives, whatever the drivers, what the different persons accounts also verification will be happen, because the transactions will be some unanimous transaction will be there, because they will get that donation from the different persons. So he need including the verifying the sources of funds through legal documents, and third party inquiry will be conducted, and continuous anti money laundering, that is CAPS, will be there. Here the CAPS meaning will be ongoing monitoring of customers and transactions to identify the suspicious activity. This CDD EDD will at the time of initial time, and CAP means ongoing term during the monitoring. Here that might indicate money laundering even after initial CDD and EDD. This purpose will be to detect and prevent suspicious transaction through ongoing analysis of customer behavior and transaction patterns and potential red flags. Here methods will be utilizing the automated transaction monitoring system and risk-based scoring models and human expertise to identify anomalous and suspicious activities. For example, an investment bank's monitoring systems flag frequent large cash deposits and international transfers linked to customers previously identified high risk. This triggers further investigation and potential reporting to authorities. Risk categories. Here risk categories will be AML regulations require financial institutions to categorize customers into different risk group will be there on their case. So firstly, this type of customers, whether it will be retail customer or whether it will be wholesale customer or whether it will be corresponding banks, and based on their business activity, nature of their business, nature of their transactions, nature of their risk is involved in activities, and what are the source of funds will be there, legitimately and transparency of customer financial resources, whether the person is doing the job or whether the person is retiring person, whether he is getting retirement income, whether he is getting business income, whether he is getting pension income, what is his source of income we will see. And geographical location. Here countries with higher money laundering risk may warrant a higher risk rating for clients based there. So applying the CDD, ED and caps to risk are categorized into low risk, medium risk, high risk. Here low risk we have retail clients with simple investment goals might require only basic CDD will be required, and only CDD is enough for low risk persons. You have minimal ongoing monitoring will be there. And whereas medium risk, here the wholesale clients or activities which have moderate complexity might necessitate standard CDD and EDD processes will be required, and along with more regular transaction monitoring. Whereas high risk will be there. In high risk clients or transactions deemed to be highly suspicious due to some specific red flags will be there or risk factors would be triggered. Here enhanced ED measures and extensive ongoing monitoring potentially involving external experts and authorities will be required for the high risk persons. So we have low risk and medium risk and high risk persons. Next after that we have equity research. Here equity research means involve analyzing publicly traded companies. So which we ever come for, yeah, started with IPO process. Now in IPO what is there, that private companies will come to the public entity, into the public entity. So means whoever the publicly traded companies will be there, from that publicly traded company will analyzing their data by this equity research for assessing their financial growth, and we see that growth potential and competitive landscape. These analysis forms will be based on investments recommendations. So based on that analysis they will give them recommendations, they will give some industry reports, they will value the company's valuation, they will gather and data analysis, and they will build the valuation models. And here the equity research will analyze the publicly traded companies information, and after that they will assess some financial health and growth potentials and competitive landscapes. So these analysis forms may be based on that investment recommendation for the purpose of investment decision, if you want to buy or if you want to sell or if you want to hold, so whatever you need. So based on that equity research decision you can take the decision for specific stocks. So if you want to buy the Reliance company shares, so this equity research will tell buy in February month or sell in March month or hold in July month. So they will tell by analyzing the publicly available data based on their financial health, growth potentials and competitive landscape. And they will industry reports insight and forecast on broader market trends and sector performance. So they will insights and forecasts on broader market, what are the market trends will be there, what are the sector performance will be there, they will take. And company valuations, here determining the intrinsic value of a company for potential investments or measures. So they will see the company valuation, they will determine the intrinsic value of a company for determining the potential investments or measures. What are the roles will be there for this equity research team? Here equity research team within investment banks, they will compromise analyzed with specialized experts in different sectors. They may be technology, they may be go for healthcare, they may be go for energy. So they will analyze the specialized expertise will be there for different activities or different sectors. The core roles may include will be data gathering and analysis. So they will gather the data and they will analyze the data. Here scrutinizing the financial statements or company news or industry trends and competitor analysis will be there. So they will core roles will be they will gather the data and analyze the data, they will scrutinize financial statement, they will see the company news, they will see the industry trends, and they will see the competitive analysis. After that building valuation model. Here building valuation model means quantifying a company's financial performance and future prospects to estimate its fair market value. So building valuation model means quantifying the company's financial performance and future prospects to estimate its fair market value. Writing the research report, so they will write the research report. Here communicating research findings, so investment recommendations and market insights to their clients. Next meeting with investors and companies, presenting research findings, answering questions and attending industry events. And after that we have the top down or bottom up approaches. We have two primary methodologies of a different perspective on analyzing the company. So for company analyzing we have top down or bottom up. So in top down we have focus starts with macro views. We will start with macro views, and after that we will analyzing the macroeconomic factors. So here macroeconomic factors will be like GDP, interest rate, sector trends, whatever the will be there, that macroeconomic factors we will analyze it in top down cases. Whereas here process will start with estimate the overall market performance and then drill down to identify the individual company expected to outperform. So they will see the first overall market performance. After that they will identify some individual companies and expected to what is their performance, outperformance, what are the underperformance based on their fit within the broader economic picture. For example, if we see an analyst predict the rise in oil price due to global economic recovery. So they will predict the oil price, yes, due to global economy recovery. They identify energy company with strong production capacity and favorable cost structure has potential by recommendation. So when they are predicting price is going high, means here price is oil price is going high because of this economic global economic recovery, then they will identify the energy companies who have strong production capacity, they will favorably cost structure, they will recommend buy the price because the price is going high. This is the example. And bottom up approach means here focus will start with microwaves, that is meticulously analyzing the individual companies. They will start with individual companies, financial health, competitive advantage and growth perspectives. Here process will be deep dives into company's financial management strategy, product pipelines and competitive landscape to assess intrinsic value and future potential. So whatever the intrinsic value means present value of future cash flows. So whatever the future cash flows will be there, for that future cash flows we have present value, converting that into present value. This is known as intrinsic value, that is footage presence. For example, an analyst dives into specific tech company innovative new product with segment market potentials. So they build financial model forecasting substantial revenue growth and recommend the stock has long term investment. Here we need to choose right approach will be required. So right approach means optimal approach depends on various factors. So various factors here, first maybe market conditions. So whatever the market conditions will be there, in top down is more relevant in volatile market where macro forces dominates, and in case of bottom up shines in a stable market more company specific factor prevails. So in bottom approach we will go with the individual market, in top down we will see in a market level, overall market level. Next, if you go for the investment margin, in investment margin the top down suits market trends and short term decisions, while bottom up caters to individual company analysis and long term investment strategies. Next, analyst expertise, whatever the analyst have expertise knowledge. So analysts often specialize in preferred approach leveraging their strength and market knowledge. Here conclusive will be equity research is a powerful tool in the investment banking. So this person have powerful tool in investment banking, and understanding the top down and bottom up approaches empowers you to navigate market analysis with greater clarity. And they will remember both approaches possesses unique strength and choices often lies in the balancing macro and micro perspectives to make informed investment decisions. So these are the powerful tool in the investment banking. They will understand from top down to bottom approaches empowers you to navigate market analysis with greater clarity. And here both approaches possesses unique strength and the choices often have balancing macro and micro perspectives. They will inform the investment decisions majorly. Their role will be here equity research in investment banking empowered informed decisions. You will analyze the publicly data, assess the financial growth and growth potential competitive landscape and forms basis investment decisions. You will investment decision, you will give investment decisions, industry reports and company valuations. Here key roles will be what we have seen in key roles, that is data gathering and analysis, that financial statements, news, trends, competitors data, they will gather that information, they will analyze that data, and building valuation model to estimate the fair market value, where writing the research reports to communicate findings and what are their recommendations. In recommendation we have seen that oil company is by the prices because the price is going more, and they will meet the with investors, and they will companies to present insights and building relationship. And we have top down and bottom approach. So in top down it will start with macro factor, that GDP, interest rate, sector trends, and drills down to identify the promising company within those sectors. Example, this predicting the oil in price leads to buy recommendations for energy companies with a strong production capacity. Where bottom up means it will start with individual company analysis, where financials, managements, productive and competitive landscapes to assess the intrinsic value and growth potentials. Here analyzing the tech company innovative products with strong market potentially lead to buy recommendations for long term investments. And buy side, here the persons may go for the buy side or sell side. And investment selections, researchers will guide informed decisions about which stock to buy, which stock to hold, and which stock to sell. And they will use a metric like this: EPS, ROC, and ROCE, and free float market capitalizations. For example, research highlights promising the tech companies with innovative AI technology leading to buy the decision. So they will highlight the tech companies. You need to take that AI tools, because AI tools is growing like anything. Growing is the main important. Next, portfolio construction. Here researchers did ads, diversification, and allocation of capital across promising sectors. Next, for example, portfolio managers will allocate the funds across technology, healthcare, and consumer staples based on research. Next, valuation and negotiations. Here, research reveals a company intrinsic value, enabling the negotiation of fair price. Example, activities investor negotiate a favorable takeover bid based on research backed insight. This is buy side, whatever they will do in buy side. Here we will see the sell side. What does in sell side they will do? Client recommendation. So in sell side they will recommend the sell side analysts provide research and recommendation to clients, advising on buy or sell or hold decisions. Here analyst will recommend buy for biotech company with promising drugs trial, or whoever giving promising on trial, then only you will buy. They will tell the for the biotechnology companies. And market insights and executions. Insight side, teams offer insight into market sentiments, sector outlooks, and potential catalyst for stock price movement. So example, sales side team highlight defensive sector during the market uncertainty. Here company relations and deal generations. So sell side analysts often have close relationship with companies, so acting a bridge to potential investors. For example, strong relationship facilitate a successful IPO for startup companies. So company in a relationship, they will deal generation, they will sell the side analysts often have close relationship with companies who will act like as a bridge to potential investors. So strong relationship will be there for successful IPO for the startup companies. Here some key metrics we have discussed, that EPS, ROC, ROCE means what is this? EPS means earning per share. Here earning per share, EPS means measuring the profitability per outstanding shares. So whatever the profitability will be there per outstanding share, we will measure. For example, company A with EPS of $5 is more profitable for shares than company B with EPS 2 rupee dollar. So more EPS means that more good company. So good company will have more EPS. And here we measure with EPS will be profits after tax divided by number of shares. So here measure profitability per outstanding shares. Next, after that ROC, that is return capital. Here the efficiency, here profitability we have measured. Here ROC efficiency will be measured in generating profits from invested capital. For example, company C with ROC of 15% utilized capital more efficiently than company D with ROC of 10%. So company C have 15% utilization more efficiently than company B with ROC of 10%. So whichever company are more ROCs, it will utilizing more efficiently their capital. So return divided by capital. Next, ROC means return capital employed or return capital equity. measure return on investment for common shareholders. Here we have in EPS we have profits divided by number of outstanding shares, whereas after that we have discussed about return capital means return divided by capital. Here the capital means equity, and after that ROCE means return capital employed. Here return divided by capital, here also capital. Here capital means we will have equity plus debt, that is the case. Next after that free float market cap. Free float market cap means market capitalization calculated only freely traded shares. So in in company we have share capital. In share capital they may be have promoter share and available for retail investors. So for this retail investors, what are the amount will be there? This is free float market capitalizations, that is freely traded shares. Next IRR. IRR means internal rate of return. This is discount rate that makes net present value of an investment equal to zero, that is NPV to 0. If you are taking any investment decisions, when the NPV is positive, then only we will consider that is the good decision. If the NPV is negative, we should not consider that decision will be good decision. Next PE, that is price to earning ratio. Here comparing the stock price to earning per share. Here we will compare the stock prices and with the price earning shares. And after that example, company E with PE 20 compared to industry average 15 might be overvalued. So when we have more, it will be treated as overvalued. And after that physical deficit. Here physical deficit, the difference between the government total spending and total revenue. Whatever the government getting from the public and whatever the government spending for the public, here if the spending is more than the getting, then it will become the physical deficit. Here impact higher deficit wins signaling increasing government borrowings. When we are spending more, we need more. So when we need more, we borrow more. When we are borrowing more, we need to pay more, that is interest. Here potentially leading to higher interest rate, and it will go for inflation. It also affects investors confidence and limit resources of other government programs. Here decision making will be business may factor in potentially taxes may increase. So when the government has physical deficit, they will increase the tax rates because they will get the income from the tax only. So they will increase the tax rates, and spending cut due to high deficit are influencing investment and hiring the decisions. So consumer may adjust their spending based on concerns about future economic stability. Next after that interest rates. So interest rate means here meaning cost of borrowing money or set of central banks like Federal Reserves. Here the impact will be low interest rate make the borrowing cheaper, stimulating economic activity, but can also contribute the inflation. If you have high rates, discourage the borrowing, so we will curb the inflation. So if we have more interest rate, we cannot borrow. These companies will not borrow from the banks. If the banks giving less interest, then the companies will borrow money and they will try to go for some taking some risk and investing in different types of business, different companies, different startups will become. When different startups will become, the more employment will create, more spending will be created. If the interest rate is more, the companies will not borrowing and companies will try to cut the cost. By cutting the cost, they will focus on this employees salary, based on their salary. And consumer consider rates when taking out loans or mortgages, impacting the spending and assets purchases. Next, monetary policy. Here action taken by central banks to influence economic activity and inflation, primarily through adjustments in interest rates and quantitative easing programs. So monetary policies means whatever the action taken by the central banks, it will influence the economic activity and inflation. So primarily through some adjustments in interest rates, they will quantitative the easing the program. So next, what is the impact of this monetary policy? Expansionary monetary policy, that is lower rate, that is QE, that is qualitative easing, aims to boost economic growth, while contractionary policy, that is higher rate, focus on curbing the inflation. So lower rate, it will boost the economic growth, higher rate, it will curb the inflation, that is monetary policies. Here decision making will be changing monetary policy influence the investment decisions. If the monetary policy is changing, then investment strategies will need to change, business borrowing decision will need to change, and consumer spending pattern also will need to change. So understanding the policy trend can help the anticipate future economic conditions, adjust the decision accordingly. Next, after that, inflation. What is meant by inflation? Inflation means the rate at which the general price level of goods and services increased over the time. So what is the rate, what is the general price level of goods or services increasing over the time? Here impact will be low inflation, generally it indicates stable economic growth, while high inflation erodes purchasing power and discourages the investments. Next, decision making. Here businesses adjust pricing strategies and wage negotiations based on the inflation expectations and consumer factors in inflation when budgeting and making purchasing decisions. Next, after that, PMI, that is purchasing managers index. So purchasing manager index means here they will go for one survey, that survey based on indicator of business sentiments in manufacturing and services. So what is the manufacturing sentiments is there, what is the service sector sentiments is there. So based on that sentiments, they will survey that sentiments, based on that indicators sentiments, they will take the decision. And here impact will be rising the PMI, that is purchasing manager index, typically signals economic expansion. So when more is purchasing means he is going to more production, when more production will be there, more expansion will be there, while falling PMI indicates contractions. Next, here decision making. Businesses use PMI data to assess the current economic conditions and inform inventory management and production schedules and hiring decisions. So investors may use PMI has leading indicators to future economic performance. Next, after that, GDP. GDP means what? GDP means gross domestic product. Gross domestic product means the total value of all final goods or services produced within a country in a given year is known as GDP. GDP means total market value of all final goods and all services which was produced within the country, that is gross domestic. So domestic products, so domestic product means within a country, whatever the goods, whatever the services, that market value of total market value of all finished goods and services which was produced within the country in a given year, that is known as GDP. If the GDP for last 2 consecutive years GDP is in increasing trend, it will become a recession, and recessions will be happen, the companies will try to reduce the cost. When company is trying to reduce the cost, the first persons who will affect these employees only. When the recessions is happen, employees will get out from that companies. In here impact will be GDP is key indicator of overall economic growth and overall economic health and growth. Here decision making will be businesses and government will analyze GDP trends to identify the growth opportunities, allocate resources and formulate economic policies, and consumers may adjust spending habits based on the perceived economic performance as reflected by the GDP. Here we have different methods will be there for measuring this GDP, that is gross domestic products. For the methods we have mainly product approach method. Here product approach means the value added at each stage of production will be adding. So some the value added at each stage of production during the year. So that is production method. So whatever the production cost is there, that production cost will be considered as one measure for GDP. And after that we have income approach. Income approach means adding up all incomes earned by factors of production. So whatever the incomes earned by factors of production, they may be wages, they may be profits, they may be rents, they may be interest, whatever the income, so all incomes will be added. That is income approach. After that we have expenditure approach. Expenditure approach, we have total all final expenditure on the goods and services by consumers, business and government. This all expenditure is known as expenditure approach. Next we have currency market. What is mean by currency market? In currency market, the global market for exchange currency is known as currency market. Means currency market means globally it is one market, it is globally market where we can exchange the currency, that known as currency market. Here impact will be fluctuations in exchange rates affects imports and exports cost, travel, investments. So whatever the exchange rates will be fluctuating, it will affect its imports, it will affect its exports, it will affect cost, it will affect travel, it will affect investments. Decision making, here businesses will consider exchange rate when pricing exports and imports, while investors use them to diversify portfolios and hedge against currency fluctuations. After that we have derivative concept. So in derivative concepts, I think it was Mr. something, I think so, swaptions. So we have missed some concept relating to derivative. I think I will give that derivative concept in next video better, because we have missed some pages. I think 2 pages. First derivative definition will be there, and after that we have derivatives features, options, put option, call option, forwards, swaps and swaptions. These different types is there. We have given only differences here. So we will OTC counter. So we have here differences. So we will take firstly what is the differences will be there. So in derivative means, simply derivative means it is one financial contract which does not have a value for it individually. So based on its value will derived from the underlying assets. Here the underlying assets may be shares, securities, bonds, debentures, whatever will be there. And after that it will be have different types of different of derivatives. So in derivatives they will regularly follow with OTC and exchange traded derivatives. OTC means over the counter. So they will over the counter, here traded directly between parties. There is no exchange will be there. In OTC there is no other third party, so only between parties they will trade that directly. And here we may have customization and flexibility will be there. So how much we require we will tailor made will be there, and less transparent pricing and higher counterparty risk. So here two persons were talking, and two persons in one person may pay or may not pay. In that case the pricing transparency will be less and higher counterparty risk will be there. Whereas exchange trade, so exchange trade means here the stock exchange will be there, that is traded on regulated exchanges. Standard contracts for liquidity and transparency will be there. Central clearing houses for risk management. Here we see, for example, case scenario, bank exchanges interest rate payments, that is OTC swap, customized swap. It is related to swap na, I think so, swap forwards. Okay, all examples were provided here. Bank exchanges interest rate means it is OTC swap, that is customized swap terms to meet specific needs. Investors speculating on oil prices, this is future, that is buy oil futures. So we will see the first buy and forwards and futures, and I will explain later in also, but we will see just differences, futures versus forwards. In future we have customized contracts traded on exchanges. How in futures we have standardized, means lots will be there, and they have fixed specification for underlying assets, quantity, delivery date, prices, etc. And market to market daily, and meaning gains or losses will be settled at daily basis, that is daily settlement will be there. And after that involves central clearing houses for risk management. Whereas forwards. Forwards means in forward we have customized contracts that is negotiated directly between two parties over the counter, and we have terms related to tailored to specific needs of parties will be involved. A settlement will be there at expiration day. Before expiration also we will go for the futures settlement. No central clearing house, potentially higher counterparty risk will be there. Here the airlines company is there. For example, forwards, it was entered forward contract with fuel supply for fixed price jet fuel deliveries over the year to mitigate the price volatility, because this airlines major expenditure will be major expenditure will be fuel only. So for fuel they will fear on fuel rates, so they will enter the forward contract for entire this year. You need to deliver the fuel with the specified price, that is forward contract. Here delivery will be there and price settlement will be also there, that is airline company entered. And whereas futures in gold investors, for example, gold investors buys gold future contract and exchange to speculate on the price increases. So he is thinking, one person he is thinking the gold price will going up in future, so he will enter now itself, and on that day when the price is increased he will take the delivery and he will sell at that market, he will get the gain. That is his mind, and here benefiting from daily settlement and standardizing the terms will be there. There has call option, put option. In derivative major contract will be call option, put option only. So in call option we have call option give buyer the right to buy the underlying asset at a specified price, that is strike price, by expiration date. Here using for betting on prices will be increased, so bullish trend will be there here. So bullish trend will be. Call option means here buyer means that company will get the right to buy shares. Where has put option? Put option means here buyer give buyer the right to sell underwriting at strike price by expiration date. Here using for betting on price declining. Here maybe bearish market against the potential loss. So for example, investor bullish on tech stocks, that is call options. He will go for the call option. He will buy call option and hope the profit if the price is rises. So he will think price is going up and he will take the call option. And investor hedging stock portfolio means here buyers put option to protect against the potential market down. So he will think market is going down, to protect himself he will buy the put options, and that is the call option and put option. After that we have seen that another one, swaps and swaptions. Swap means here contact between two parties to exchange their cash flows based on different interest rates or different currencies or other benchmarks. So we have three types, majorly different swaps will be there. We will discuss on interest rate swap or currency swap or total return swaps will be there. For example, a company with fixed rate debt might enter a swap to exchange its fixed payments for floating payments. So fixed payment to floating payment, it is interest rate swap, potentially benefiting from lower interest rates. Key features will be, that is OTC related, I think so. Meaning of option always traded OTC. Swaps involve ongoing cash flow exchanges. Swaptions are only involves upfront premium at potentials, cost, flexibility, risk, swap. So we will see in the next class relating to this. So thank you.